Hi everybody, this is Jonathan Tran with Paramec Financial with Finance in 5 to 10 minutes. This time we're continuing our series on business life insurance and continuation planning. Last episode we talked about buy-sell agreement. This episode we're going to talk about key person insurance or key person indemnification. What this means is that this life insurance is on the employee but for the benefit of the business. Again, let me repeat again, it's on the key employee but for the benefit of the business. Now, what does that really mean? What that means is that sometimes when we have a business, there's always a key person to the business, right? A key manager, a key CEO, a key CFO. If we were to lose that person, it would be detrimental to the business, right? And a lot of times in order to make up for this loss of this person, if they were to pass away or if they became chronically ill or disabled, where will we get the money to recoup their loss? Because one is operations could be affected, and how much loss could you have cash flow wise by losing this person? Or maybe you lost this person and now you have to go recruit another person with similar qualities. How much money would it cost you to recruit that person? Whether they're working for somebody else and now you're trying to pull them over and you want to give them a sign-on bonus and you want to give them all these benefits for them to come over and work for you. You have to plan for these type of things, right? A lot of times, like we think we hit a home run by having a superstar in our team, but that superstar went away, something happened to them, and now your business is affected because you don't have your superstar anymore. So the business has to protect themselves as well. And by using a key person life insurance, you'll be able to leverage the life insurance to be able to cover for those costs if something happened to that key person. For example, you have an high-paying executive and they're valued at $2 million. So what the business would do is a business would buy a key person insurance on this individual. Now you can't just buy it on anybody. You have to prove that this person is a key person and you have permission to buy life insurance on them. They can't just be a random person and you just want to buy life insurance for them. You have to have a insurable interest, a relationship with this person as their employee, and they are proven that they are a key employee of your company. Then you can buy the life insurance on them. So during the time that they're still alive, the company would pay premiums to the insurance company to buy this life insurance on them. Now be careful is that because this is for the benefit of the business, and if you want to take a tax-free benefit when that person passes away, the premiums are not tax deductible, okay? So make sure that you keep a note of that. Now what happens is that when that person passes away, the agreed amount that you value that person at, say for example that $2 million we use example, that $2 million would be paid tax-free to the business, and the business would be able to take that $2 million to go and try to recruit a new person to replace that person, or maybe replace the loss of income from that person being gone in that time frame where they have to replace that person, right? Now, another thing that could happen is, what if this employee loved the company, stayed with company all the way to the end until the retirement, but they have this policy. There's two ways that they can structure it. One is you can do like a term policy where maybe they have a contract with you, and after a certain number of years, the contract's over, then the life insurance policy goes away. But what if you want to do a policy that has more benefits, a permanent policy that lasts a lifetime? And this employee worked a lifetime with this company and now they're retiring. Now all these premiums paid into the life insurance policy, what happens to it? Well, what they can do is if the employee wanted to, and most likely it'd be a good idea, is that they can structure it where when the employee retired, this plan could be given to them as like a retirement bonus, right? And then they would transfer that policy to the employee, and now the employee can change the beneficiaries from the company to their own family members or their trust or whoever their beneficiaries are, and now they have this policy that has been paid by the company all these years, and now they have basically a policy. Now, of course, they may pay the taxes as a compensation to them as a retirement compensation, but at least they have a policy already ready for them when they retire, right? So key person insurance, very key, very important for businesses that need to protect their interests in their employee in case something happens to them, they have money to recoup. But at least you know that, hey, at the end of the day, if that person retired with you and you gave that policy to them as a retirement bonus, at least you can write off some taxes there, right? Because now that policy is no longer yours, it's now the employees, and the employee will pay the taxes on that compensation, and everybody's happy, right? Key person insurance, very, very important. One of the common ways to help retain your employee in the long run, but at the same time protect your business in sense of a disaster, right? We talked about disaster planning. This is one of the things that you can use for disaster planning. So I hope that was helpful for you guys, very informative. Follow the link below for the last one that we're gonna do on executive bonus plans, very fun topic. And then make sure you like and follow our video, subscribe to our channel, and I hope you guys learned a lot today. Thanks a lot. Bye-bye.